Employee ownership trusts, first introduced in the Finance Act 2014, have become increasingly popular over recent years. One of the reasons for this is the headline rate of 0% capital gains tax, whereby shareholders in a trading company can effectively sell their shares for full market value without paying any capital gains tax. And naturally, I think the awareness has also grown over recent years, and therefore more and more business owners are exploring this route, especially in line with the budget on the 30th of October 2024, whereby capital gains tax rates have risen from 10% to 18% at the lower rate and 20% to 24% at the higher rate, and therefore there are more incentives to explore the employee ownership trust. In this video, I'll be outlining 3 advantages and 3 disadvantages. I think it's very important that rather than just 0% CGT, just talking about that one angle, I think it's very important to have a well-rounded idea in terms of how it works. Before we go on, don't forget to like, comment, share and subscribe to our channel. My name is Omar Aswat, Chartered Tax Advisor. The first advantage, and this is a major advantage, but as I say, keep watching the whole video to understand the advantages and the disadvantages. The advantage is the fact that there is a 0% capital gains tax rate on the disposal of shares by the founders, the owners of the business. Now, as I say, naturally, that is very, very attractive. And the disposal is effectively at full market value. So 0% capital gains tax at full market value proceeds. Just keep in mind, I think one misconception is around the angle whereby some believe that it's an exemption. Okay, it's not exactly an exemption, it's a relief, or it's a deferred relief effectively. So that is the first advantage. Rather than paying 18% or 24%, you pay 0% capital gains tax, and that tax saving can be in the millions. Okay, we had a company whereby they sold to an employee ownership trust for 13.5 million, and therefore the tax saving there was easily over £2 million. The second advantage, and in my notes I wrote least headache, is the fact that when we're disposing of shares to an employee ownership trust, the way I tend to look at it is that the buyer and seller, effectively in a way, as in it's not exactly the case, but the buyer and the seller are both on the same side. With a third party sale, what we have is, the third party, they'll come in, they'll do their due diligence, they look to reduce the market value of the sales price. And then there's also the issues around disruption. So some of these processes can go on for months. We have the confidentiality issues as well. So therefore, the second advantage is the fact that the buyer and seller are effectively, or can be seen as being on the same side. The second advantage is more of a commercial benefit. So the first advantage was a tax benefit. The second advantage is more of a commercial, or you can say a real life benefit, which is when I made my notes, I wrote least headache. Okay. Now the reason for that is effectively the way one can think about it is that the buyer and the seller are effectively on the same side. Okay. So in a third party sale, for example, you'll have the potential acquirers. They'll come in with their lawyers, the legal team, and the rest of it, and they'll undertake due diligence, and they look to reduce the sales price as well. Along with that, other disadvantages with that route is the fact that there is a lot more disruption. Some of these processes can take 3, 4, 6 months, sometimes longer, as well as the issues around confidentiality. So the second advantage is least headache, least disruption. Why? Because effectively all parties are on the same page. The third benefit is around the employees. So as we say, once the shares are sold by the owners, by the shareholders to the employee ownership trust, the company, the business is effectively now owned by the employees. Okay, it's employee owned. So therefore, having the employees effectively having a direct stake in the profitability and the success of the business, the benefit around the sale to an EOT is around the incentivization or motivation of staff, and therefore perhaps increasing productivity and profitability. The other advantage there is around coming back to tax again, which is that £3,600 per annum can be paid to employees within the company completely tax-free. Now, when I say tax-free, I mean income tax-free. There are still national insurance contributions that need to be made, but income tax-free, 3,600 per annum, and it doesn't have to be for every single employee. It can be for certain employees. So those are the three advantages of employee ownership trusts. As I say, the situation, the circumstances have to be looked at on a case-by-case basis, but effectively, an employee ownership trust can be very beneficial for business owners. As we say, the headline rate of 0% capital gains tax, this is something that we regularly get involved in, and I believe will continue to be involved in over the next few years, especially with the increase in capital gains tax rates. In terms of how we benefit or how we bring value to the transaction process is around the initial analysis, the initial advice. We also obtain advanced clearance from HMRC. So there are conditions that need to be met, very strict conditions that need to be met in order to benefit from the 0% capital gains tax. And therefore we obtain, or we prepare and obtain advanced clearance from HMRC. Effectively, it's a stamping that, the tax benefits do stand. We move on to the disadvantages. So the first disadvantage is around the disqualifying events. What this means is effectively, as I mentioned, there are conditions that need to be met. But conditions, they not only need to be met prior to the transaction and to get the 0% capital gains tax relief, as we say, it's not an exemption, right? The relief, there are also conditions that need to be met following the sale to an EOT. And how we get involved is we constantly monitor that the conditions are being maintained. So there are many disqualifying events. I think the main one would be that if the trading company is sold in the same tax year or the following tax year, then the CGT relief is clawed back. Okay, so that's a disastrous circumstance for the owners, and therefore that must be managed. The second disadvantage, and we can't really call this a disadvantage, to be fair, it's just part and parcel, you can't have everything in tax, right, is around the 0.5% stamp duty, which is payable on the consideration value, usually full market value. And this stamp duty at 0.5% is paid by the trustees. And the third disadvantage is in relation to the deferred consideration. So usually what we see is that the owners or the outgoing owners who are selling their shares to the employee ownership trust, they usually get paid a percentage upfront or on transaction date, but most of the time there will be deferred consideration, and therefore the disadvantage, again, which needs to be monitored, and this is why I constantly mention that the wider angles need to be considered rather than just the 0% capital gains tax, is around the fact that if profitability decreases and the company begins to suffer a decline, then there is potential that the owners won't be paid their deferred consideration. So that is a disadvantage, a drawback, you could say, which needs to be monitored. I hope you found the information, the advantages, the disadvantages useful. If you have any questions, as always, please don't forget to reach out. Our details are down below. And as I say, we can expertly assist on such life-changing transactions. Don't forget to like, comment, share, and subscribe to our channel. And I shall speak to you soon. Thank you. Bye.